The he told about real estate. So basically, it's all about formation of a company at various stages and various stages of funding. This is what he was discussing about. It was almost covered in Professor Rajwanshi's session. So we can just briefly cover it before we go into other things which are important. Like he It started with like a farm which may initially start up with as a startup. It may come out with its own fund. Later, they may be searching for, funds or the investors who would be investing into the farm to grow it big and to expand even further, to get even accumulate more and more investment so that it can grow continuously. So to start with, they go with immediate family members, then later on with angel investors who has faith in that, and then comes is the serious business of private equity by financing. There are many stages. In the seed capital stage, it is like they try and test with an idea, develop a prototype, and conduct market research in a particular segment or area. Like for example, Swiggy starting with, I think it started with Bangalore. So once they developed quite a good amount of confidence levels and people understood the model, then they came up with the startup stage where the people of especially private equity investor, they started putting money into it. So they funded the company with they had a well defined business and marketing plans because they have already tested a prototype. So there will be, they know the entire of the nuances, the risk factors, and the market capabilities, and the kind of a business model, and the kind of a team they have, and the experience they got. So they make certain changes, amendments into their entire model and come up with a very robust plan. So that robust plan is sold to the so-called private equity investors because the company is not a full-fledged and public company, public listed company where many people will be interested to invest into because it's a startup. So then comes the private equity investors. Basically, these people are they are the people who have domain knowledge about that particular segment, or those they may be ex CFO, CEOs, and somebody with a lot of vast experience in that particular segment. So they are the one who come up with the cash bags and investment plans. So it start up with their startup plans. It goes with a series of negotiations, and finally the investment is in land up in series. I think he has shown the website of let me just tell you one website in which he has shown the various stages in which all those investors have gone into. Like in that particular thing, it went up to G series. So uh, then later, once they firm up and the firm grows bigger and they have a much bigger, robust plan, and they want to go for pan India or further expand their business, they go into expansion stage where they require financing to expand their capital productivity or production capacity, then product development, or to provide further working capital to expand the business. So this is the stage where they may go for IPO, and they go into a market. So finally they expand further, and then with finally it may depending on the maturity of that particular product life cycle, and then the so-called industry life cycle, they'll go to expansion stage, and later they may decline. During the declining stage, the firm would like to go for something called as a capital replacement capital, or to reduce the financial leverage, so that the company is now no more in the expansion phase. So they want to reduce the risk, and whatsoever. The financial leverage reduction is only to ensure that the most of their incomes or the earnings, EBITDA, is into the so-called debt capital, debt servicing charges and all. So finally, when the company purchases its own equity from the other stockholders or the shareholders, it is called as the replacement capital. Next slide, please. So there are various stages and types of private equity funding. It can be acquisition capital, primarily by any other company who want to acquire totally cash out. It may be totally cash is paid by the acquiring company to the acquiring. So this is acquisition model. Leverage management buyout is basically predominantly it is funded by debt rather than equity. In the first one, it is predominantly or rather totally an equity kind of a thing. Cash is directly infused, and then here the cash is a mix of both equity and debt. Then mezzanine is it's a kind of a subordinate debt or warrants, convertibles, preference shares. Then which has an option to get converted into an equity. Then when the company is under distress, then it may lead to financing of financing of financially distressed companies. So that may be sold at a very cheap price. Maybe many a times we have seen like Alok getting sold to Alok Industries to Reliance at 80% haircut. And like that, there are many other deals like Bhushan Steel is one example in the power sector, and SR Steel, Bhushan Steel in steel sector. Even Bhushan Power also was being sold. So many other power and steel companies are sold after 2008 the global meltdown. Next. So there are India is one of the leading, you can say, unicorn startup ecosystem in the world. We have around 100. These are the names of those companies. Most of it we all know it, like in Mobi, Flipkart, Musicma, Snapdeal, Paytm, Ola Cabs, Quicker, Zomato, etc. So there are 100 names to it. You can just go through the list. It's only for your information. Um, Praveen, Praveen, kindly admit more people into it. There are some waiting. Praveen, can you hear? Praveen, seems Praveen is busy with something else. Yeah. Okay. So, welcome, guys. I can see two Sudhirs right now.
Yeah, it's my enthusiasm. Since I missed the morning thing, I'm thinking.
To compensate it. Yeah. Next. So these are the funders of those 100 startups, mostly by fintech, SaaS, e-commerce, marketplace, etc. These are the list which you can go through this study. And predominantly unicorns have come up, one in fintech space and then the other is e-commerce space. Next slide, please. The other ones are SaaS based, e-market space, then marketplace, edtech. These are few of the sectors where most of the startups have come into. Next. I think these are the companies. These are the list of companies. If you see the entire of the list, it's fintech, SaaS, then e-commerce, marketplace, edtech, logistics services, so on and so forth. Next, please. Now, who funded these startups? These are the uh, funding agencies. There are around 159 private equity and venture capitalists which who have invested into all these startups. And the largest of all is Tiger Global and Stepwise Capital India, SoftBank, SL India, Stadview Capital, Elevation Capital, etc. These are the names like which you can go through this particular slide. Next, please. And you just see what are the companies these top companies have invested. Like Tiger Global investing into Flipkart, Ola Cab, Shopclues, Hike, Byju's, Policy Bazaar, etc. SICK was into Pine Labs, Unacademy, Razorpay, Car24, Daily Hunt, 5 Star Business Finance, Cred, Meesho, Grow, etc. SoftBank, Immobile, Flipkart, Snapdeal. And if you see the entire of the list, few of the investors they have invested into, each company getting two or more private equity investors or the so-called venture capitalists. So next, please. So, what is the value creation in this particular private equity? This is what where he has spent a lot of time. Basically, it is a re-engineering of private firm to generate superior returns. It may be what these people bring in the value. It may be like they bring in in-house high-end consulting capability by seasoned industry veterans. Usually, most of these venture capitalists or even the private equity investors either former CEOs or CFOs or senior advisors with various companies. So they bring in their vital consulting capabilities and also their experience in those sectors. So that will help the firm to grow, increase their earnings growth, and they give the strategies how to expand it even further, and what kind of optimal debt leverage they can take in that particular segment for that particular industry. And also they have the ability to access the credit market on favorable terms. Like normally, if a entrepreneur, if a startup go into the market, they may not get because they don't have that leverage to get access to free, you can say, a lower credit or cheaper credit. So these companies will help them to get that debt financing, either from syndicated loan market or from leveraged buyouts. They structure the entire financial products either as CDO or CLOs. So then they have a better alignment of interest, owner and management, and result-driven management pay packages, since they know the industry structure well and then they are successful in their own industry. So they come up with certain contractual clauses which are tag along, drag along, etc. Next. So this chart explains how this particular company, a startup, gains value in the from the beginning or from initiation to the exit. So what adds to the value is, apart from the cost, it is the earnings growth, then multiple expansion value drivers. That may be in terms of PE multiples because they have performed well, and then market has accepted a little more PE compared to what it used to be during a pre-valuation stage. So that multiples, and then there may be a kind of a debt reduction, and that also add to the value to it. So by the time it is being sold, they get value because of these drivers. Next. So he explained something about leveraged buyout. Leveraged buyout is a company purchasing another company predominantly with the help of a portfolio of both equity and debt, in which debt may be somewhere around 80%, while equity is just 20% of it. Then expected revenue return from providing financing, IRR sensitivity analysis on expected holding horizon, and exit valuation, expected multiple exit multiples comparables. These are how they increase the valuation of that particular company. Then amount of financing available for the transaction, like equity, senior debt, or high yielding bonds, mezzanine. Mezzanine is a kind of a hybrid financing, a bridge between debt and equity. Basically, it starts with a debt instrument, convertible at the later stage into an equity. Next. So he gave an example, leveraged buyout, enterprise valuation at the time of C. This is a problem, which he has shown. Should we do that, or You guys are aware of it.
So in a nutshell, if you go back to the graph, Suraj bhai,
Yeah.
and if we can see the graph one more time, the cost, which is basically the leverage cost, where the investor is basically investing, then the earning growth is creating the better valuation. Then multiple expansions also creating other valuation for the group, and the debt reduction, if happened, that's the position where they create the value of the equity, right?
They increase the,
And
yeah,
then
value.
then they convert their leverage position to the equity and the exit.
Right.
Is my
This is
reading
a,
right?
yeah, 100% correct.
Okay.
Next. So here, what he says is he has shown us with all, he did almost, I think he took more than an hour to just explain this particular problem. Like, go to the previous slide. See, I'll just read it out. Enterprise value of at the time of acquisition is 5,000 or $5 billion. So it is partly funded by, in the sense, 50% debt and 50% equity. The equity financing is 2,500, sorry, 2.5 billion, out of which 5 million is by the management common equity. Whereas 95 is the PE, private equity fund of common equity, other than the promoter's equity. So preferred equity for this PE is 2.4 billion, out of which is at the rate of 12 percentage dividend to the preference share. So this is the equity part. Then the debt rest balance, which is 2.5 billion, is the debt part. And the valuation at the time of equity exit is 8 billion dollars, which is after 5 years after investment. So during that period, they have effectively reduced the debt from 2.5 billion to 1.6 billion. So now we have to calculate the value which is derived by this particular, value for the equity investors. So next, please. So exit valuation is 8 billion after 5 years. Senior, anyway, this is how they have calculated. So residual value is 1,600, which is reduced, minus 4,000, say 4,230, because the preferred equity is 2.4 billion, into 1.12. Every year the cash outflow is 12 percentage into 5 years. So the total outflow is 4,000, or rather valuation of PE fund equity is to 4.23 billion. So if you deduct 1.6 and 4.23 billions, the balance amount is 2,170. This is shared between the equity holders. So out of which PE equity of the common equity pool will be getting around 2.061 billion, whereas management will be getting 109 percentage. And when it comes to IRR, management got an IRR of 85.2 percentage, whereas PE fund got the IRR of 20.3 percentage. IRR is a little low compared to management because they had this so-called preferred equity. Otherwise, they would have got 85.2 percentage. Next. So, what are the exit routes for private equity investments? Either through IPO whereby you either take you sell your the residual shareholding, or you take fresh equity. In this case, since it is an exit route, like during IPO itself, you can sell out whatever the amount the shareholding you have. Then in this, there is a reduced flexibility, and timing of IPO is very important. Like if you time the IPO at a wrong time, you may land up getting much lesser, or maybe it may not be fully subscribed as well. So it comes with a lot of costs, because IPO, as in the previous slides we have seen, it may it depends on, the costs vary from around 5% to 25% of overall, equity size or IPO size. So then there is another option of selling through the secondary market to another financial strategic investor if it is a listed company. Then the third is management buyout, alignment of interest and debt leverage for acquiring finance. So then there is a kind of liquidation whereby you sell everything. Then the problem with the liquidation is negative publicity and implication for the employees. So everybody will be, there is a risk that a lot of negative publicity and people may not view it positively, and it may lead to a lot of negative impact on that particular company. Next. Private equity fund structures, limited partner, general partner, he told about GPLP structure. Limited partner fund investors basically, and GP are the ones who carry not only 2% management fee and also carry out minimum 20% of interest. It is all about 80-20 rule, where investment is by LP, whereas GP will do their generally that they will do the promoting, but finally they'll have an equity of equity interest of 20%, and whereas for the entire funding the interest of the limited partners is around 80%. GPLP alignment of interest, huddle rate is basically what is the minimum IRR which is assured by the company. Say in one of the case which we will be doing for a case study, there the minimum IRR is 50%. So that is what we are anticipating as a return for towards the investment which we make. Then the clawback provision requires GP to return this general, that is management, those people who are promoting that company. If they fail to get the so-called minimum IRR, they have to plow back whatever they have taken, that 20% or whatever that has to be given back to the limited partners. Otherwise, it will be a loss-making deal for limited partners, the people who generally invest into the fund. So, fund portfolio alignment of interest. Ratchet enables management team of firm to increase its equity allocation depending on firm's actual performance. So finally, if the firm performs better, the debt will be converted into equity. Otherwise, predominantly it will be in the form of equity preference shares. So all depends on how effectively the management team adds value to the firm. If they add more value, naturally more people will come and invest. If the value addition is below par, naturally it may lead to withdrawal of funds by the funders or the finance providers. Next.
Just Suruchi on the backside. What is this 20% on the GP? It's a little confusing. Carried interest. 20% carried interest.
See, naturally, GP is those startups. Startups will come up with an idea. They have an idea in their mind. They wanted to develop, but what they lack is the funding. So funding is done by LP. LP is a limited partner who will only fund for a particular rate of return. So usual agreement in the entire industry is like the entire funding is done by LP. Business model, then promotion and carrying the entire operation is left out with the GP. GP is the promoter. So usual formula is 80-20. So 80% of benefits will accrue to limited partners who will fund the entire operations. Whereas for the GP, who generally is the venture, the so-called startup, startup management, whosoever owns that particular founder of that particular company or the promoter, they will get 20% as a return, plus 2% management fee for operating the entire of the operations.
Okay.
Is that clear?
Yeah.
Next. So, definitions of capital in PE fund: committed capital, maximum pledge of capital by LPs. LPs are limited partners to the PE fund. Like what they would like to commit. Say a company has started, say they may commit say 100 crores, out of which what they have contributed is a contributed capital. Out of the committed amount, they may deposit that money in tranches, maybe 10 crore each or 20 crore each. So whatever the tranches, whatever the actual contribution comes under contributed capital. So the cumulative of this contributed capital is what we call it as issued capital. Okay. Then LP is legally obliged to respond to the notice of a call. In case of there is a drag down or take down, there may be a capital call which will be issued. So it has to invariably go to LP also. They may purchase, may not, but ultimately they have to be given a notice. So typically it should be given 10 to 14 days in advance to the general partners. Next. So invested capital is the contributed capital less management fee. Whatever the amount they have contributed.
These could be
Minus-
good exam questions, actually.
Yeah, in fact, very true. So invested capital will be contributed capital minus management fee. Then the amount of capital actually invested by the fund in portfolio companies. Then the paid up capital is basically cumulative amount of contributed capital since the fund inception, since the beginning. It may be in many stages, many series of funding. So that entire cumulative effect is paid in capital. Next. Private equity fund structures. He described a lot about tag along, drag along. So let me check. So contractual provisions for management in a share purchase agreement for future potential acquisition. Tag along is if they come along with that particular thing, it is a tag along. Drag along is if they say exit, something like that. I just have to confirm. Anybody can pitch in?
Yeah, so the tag along is whenever the promoters sell over the shares, the PE has right to sell on a pro rata basis. That's a tag along.
Yeah.
The drag along is where the private equity or the venture capital investors when they exit, the pro rata shares need to be sold along over by the promoters.
Acha. Drag along is like, see, a provision make company more attractive to potential buyers.
Correct.
Whereby buyers often want full control of the company, and drag along provision ensures 100% of the company is for sale, not a majority. They want a total share.
Correct.
Whereas tag along is a pro rata, as you
Correct.
say.
Correct. And it happens in the round of exit. That's how the pro rata shares need to be sold.
Right. So there are investment restrictions in terms of minimum level of diversification, geographic sector focus, then co-investment, first right of co-investment of GPs along with LPs, right? So both have the right to invest If LP is investing, then GP also have the right to invest. And sometimes, in especially distribution waterfall, he was explaining that, especially not in India but in elsewhere, especially US, the founder himself will be purchasing the entire stake from the LPs. So distribute to LPs first before GP receives interest. This is all about a distribution waterfall. Distribute. Right. Next. Venture capital valuation model. This is post money valuation, and how do you determine it? That is equal to exit valuation divided by 1 plus IRR power T. T is the expected time. So that gives the exit valuation. Post money valuation is equal to pre money valuation plus investment. And determine ownership fraction. Required fraction, new share issued equal to required fraction into shares outstanding. So determine share price. Investment amount divided by shareholding. This is anyway simple formulas. Next. So this is the problem area which he has, tried to explain it. He took a lot of time on this. So here there is a Vijay who is a partner in a venture capital firm. He is planning to invest 5 million in a tech startup firm. The company management has forecasted net income of 20 million in a year, in the year 7, after 7 years. So few profitable tech firms are trading at an average PE of 12-15x. The company currently has 5 lakh outstanding shares. Vijay believes that the hurdle rate of 50% is required for a venture of this risk. Calculate pre-money and post-money valuation. This is what is the problem. The solution is given in the next. So discounted terminal value is terminal value divided by 1 plus target. Target here is that they have given it as hurdle rate at the rate of 50. So 1 plus 50, that is 1.5 to the power of 7. 20 into 15, 20 is the value of that particular company, which is which is 20 million, or the net income, into multiples is 15. So 20 into 15, that is giving around 300 million, divided by 1 plus, that is 1.5 to the power of 7. The answer is somewhere around 17.5 millions. So this is the terminal value. So what is the required ownership? Ownership required is 5. This is what he is going to invest. So 5 divided by 17.5, which is the terminal value of that company. So the percentage is 28.5 percentage. Number of shares to be issued is 5 lakh into 28.5 percentage divided by 1 minus 28.5 percentage, which is 2 lakh shares. So the new share price will be the price of new share will be 5 million divided by, that is what he is investing, divided by the number of new shares the company will be issuing. 5 million divided by 2 lakh will give around 25 per share. So implied post money valuation, it will be 0.7 into 25, that is 17.5 million. This is how the valuation is calculated.
What is this 0.7? 0.7 into 25.
Hey, wait a minute. 0.7 is
0.7 into 25. 25 is per share.
per share, yeah. Per share is that.
0.7 will be the total number or million of shares post the issuance of 2 lakh shares, because existing
Yes.
is 5 lakh shares.
Correct.
And 5 plus 2 is 7.
Yeah. So 7 lakh shares into 25.
7
So
lakh shares
17.5.
into 25. That is the post money
So,
valuation.
the post money valuation and the discounted terminal value will be same.
Okay, it will always be same.
Because
Should
that's
be.
how you, because see, one is A into B equal to something. Now,
Right.
if
B into
B
A
is
is
the
equal to
variable, then the other two variables have to somehow tally to each other.
Okay.
next. Acha, what if Vijay believes that the firm will have to issue additional shares that will dilute 30% of its common equity at the time of IPO? So recalculate pre-money and post-money valuations. For this next page. So the dilution will be like the required ownership will be he has to take 28.5 percentage divided by 1 minus 30 percentage of it will be 40.7 percentage in case if you don't want it to be diluted. Otherwise there will be a dilution is additional issue of shares whereby the management and the existing shareholders stake will be reduced by that much percentage. So the number of new shares will be 0.5 million into 40.7 percentage divided by 1 minus 40.7 percentage will give you the number of shares he has to take in order to maintain that 28.5 percentage of equity. So that will be 3.43 3,43,373 shares, and the new share price will be 5 million in any case, that is fixed, and divided by this many number of shares, and this is the per share value, that is 14.56 per share. See, if you compare with the previous one it is per share it is $25. So there is an erosion, right? So this is called as dilution of your value. Then implied pre-money will be like 14.56 since you will be investing that much into zero point 0.5 existing shares are 5 million shares. So you have to pump in 7.28 million to get access to this many shares. So implied post money value will be like 14.56 into 0.84 million, because that new value which is added is translates to around 8,43,000 something. So which will be around 12.28 million. So this is the end of it, like sensitivity analysis with VC method, like exit valuation, discounted rate, investment amount, time to exit, potential dilution. He didn't discuss much about this, but just only with this slide he has ended it. So now we have finished within 20 or 30 minutes. So if you want, we can go into that. We can go to that slide.
Surajji, if everyone allows, can we look into this post money valuation and pre-money
How to
valuation
calculate, right?
in detail? Because I think there will be one question on this.
100%.
Doing, because this is an in and out job for the CFO to have the valuation ready.
Naturally, anybody who have good idea, they would like to come up. Any volunteers?
I think we need to. Do we have or can we go through the recording or something like that?
We have a sheet also in which everything is given. We can go for that also. Like he told it. If you want, I can do it. Not an issue.
Yeah, if any.
He gave a different example, not the same example as is given in that. He have two examples. Could we do it?
What's it, guys?
कोई बोल नहीं रहा है. I think
Yeah, we can do that. No issues on that. We can do that.
So let us start with what he has given, right? Based
Yep.
on that only, whatever is given in that sheet, I'm going to do it. Anybody would like to help me?
What is the name of that file?
No, actually, I have it, but I'll try to do it. In case of any help, you may have to come to the rescue, right?
Okay.
Okay, because I'm also doing it for the first time. I don't know. So actually, see, as per the problem statement, it is given. He has given a particular example whereby the time frame given is 5 years, whereas enterprise value is 5 billion. Okay, enterprise value is 5 billion, which is 5,000 million. Could you see, guys?
Yes.
Can you see it? Right. Then the EBITDA, he told that
सुरेश जी,
uh,
आपका जो एक्सेल का जो परसेंटेज है ना नीचे slide, वो उसको 125 कर दीजिए प्लीज.
125.
नीचे लास्ट में लेफ्ट राइट हैंड साइड कॉर्नर लास्ट व्यू नीचे नीचे उसके नीचे नीचे बाहर एक्सेल के बाहर नीचे
प्लेस
Yes.
बोलता है ना, प्लेस स्टॉप.
हाँ
एंड वन
बस
मोर थिंग दिस क्लोज कर दो, ये वाला जो बाजू में डॉक्यूमेंट रिकवरी वाला है ना, वो क्लोज कर दो.
हाँ वहाँ पे नीचे क्लोज दिखा है वो क्लोज कर दीजिए.
Right?
Yep. Yeah.
Is it clear? So EBITDA
Yes,
he
yes,
has given
yes.
is 625. Then the multiples EV by EBITDA.
It's a valuation. Basically.
Value, EV by or valuation multiples.
Yes.
That is 8. This will automatically be 8. It is just simply like this. I just give a formula. This divided by this.
एक्चुअली फॉर्मूला में उल्टा किया था, ईवी निकाला था फ्रॉम ईवी अपॉन EBITDA एंड
Right.
EBITDA has been given and the multiplier has been given.
Yeah. Anyway, doesn't matter. So we need to understand the concept. So इसको थोड़ा और छोटा कर लेता हूँ because ये बहुत ही ज़्यादा accommodate नहीं कर पा रहा है. Right? Now, debt part out of this is 50% is a debt part. So 50% is 2.5 billion or 2,500 million, right? Then the equity part, in that equity, okay, now let us put it as equity. Equity is again 2,500. Then among that equity, the management C or management common equity, it is 5. This is what the venture capital, the so-called, the promoters would be investing. That's only 5 million. And the PE, that is private equity, or private equity common stock will be
95.
95. Okay. Whereas preferred equity, the PE preferential equity is to balance, the entire balance amount is preferred equity. That is 2,500 billion at the rate of 12% per annum. So the value these people will be deriving at the end of the exit. Say this is at the beginning. This is what is the one at the end. At the end of say 5 years, it became 8,000. Right? Sorry, this value of this is 8,000, and then EBITDA at the time became 800.
So it is at fifth year.
Fifth year. Fifth year, that is what he was explaining, that if you remember that slide in which he was talking about this P multiples, P multiples from 8, it became 10.
Yeah.
So that is what is that effect, multiplication effect of this P. So there is again a change in the debt and equity. Initially it was
1600. Yeah. The
it
remaining
became
one is
from
1600.
2,500 it became 1,600. So this is 1,600. Then the balance is equity. Balance will be, that will be this minus, okay,
G6.
G6. Right? So now G6 is distributed among these two. First we have to calculate how much is the outflow because of the preferential equity. Preferential equity is 2,500 into 1.2 into power of 5 years, right? So this is the amount, this is the amount towards preferential equity. So we have to deduct this amount from 6,400. So the balance residual equity will be left out with this. Sorry. Guys, I'm getting a call. 1 minute, please.
You're still on mute. Sorry.
So the residual equity which is left out after this preferential equity is 2.17 billion. So now it will be apportioned equally between management CE and PE equity. That will be So the amount, what is the return he has expected, anticipated, right? So that will be, this will be like 5 divided by 108 divided by we have to calculate IRR for this, right? Wait, let me check. IRR equals to IRR. क्यों नहीं आ रहा है? Any idea?
Yeah, IRR should be a number of cash flows, not just C9.
Yeah.
It should be a number of cash flows. It's not just one number. It should be a continuous numbers of plus or minus. Then that will give a series of numbers. Actually, in between I missed it because of some call, so that's the reason I could not follow this entire.
No. Once if we got a particular number, say in 5 years, so how will you calculate it?
Daddy,
5
where is
years.
it two?
I think let me just. I think.
Daddy, where is it two?
See, actually 108 is a cumulative figure, right? We, for an investment of 5 million for a period of 5 years. So how will you get? DC of table में तो मिल ही जाएगा, but Excel में कैसे करें?
It's a CAGR. Actually, CAGR कैसा करना है?
अच्छा, it's a CAGR, right? I'll do that. It's not IRR.
It's a CAGR.
CAGR is the growth rate. What is growing here? I forgot.
See, the
Growing is this one, 108. The growth of equity, the investment of 5 million has become 108 million in a period of 5 years. So at what percentage it has grown?
CAGR. Okay.
या CGR है क्या? इसमें कहीं पे भी नहीं है. Compounded.
No, I think we can make a direct formula. The final amount divided by the initial amount.
नहीं, ये compound करना पड़ेगा ना.
I put the formula in the chat. I think it's not a straightforward Excel formula for CAGR.
इसका क्या है?
Beginning value divided by the number of years minus 1.
Yeah. Wait a minute. I'll make a calculation. 5 equals to 5 to the power of R is equal to, or
I'm also doing it by this speed.
See, the professor has given a D divided by B. D9 divided by C9, sorry, D15. D15 means it is C9 by B9.
नहीं, एक minute. I'm getting.
I'm not 8.19 divided by 5.
हम लोगों ने कल रिवर्स रूट किया था ना. It is just like this, 108 that is equal to this divided by this, right?
That is 84% CAGR.
हाँ, ये CAGR, this we got 1%.
84%. I'm getting 84 now.
How did you get it? Can you just show it?
That's what I put that formula. You want to type that formula in the chat here?
Suresh.
Okay. Yeah.
Suresh.
नहीं वो that is okay, but Excel sheet में कैसा करेंगे?
उसको कॉपी पेस्ट करो और डाल दो 9 के बदले put 9 or 5.
अच्छा. Okay. Power into in the bracket end value divided by beginning value, comma 1 by 9 minus 1 minus
Correct.
1, right? Okay.
Yes.
Okay, I'll try to do that. Is equal to क्या बोले थे? Can you just keep saying it?
Power
Is equal to
beginning
power
ending value, which is just did that. Start with ending value 108.19
our ending value.
over
Ending value is 108 point, or else I'll just give that one.
Yes.
Yes. Divided by
Excel.
this.
5.
Then comma.
1 by
yes
9.
Comma 1 by 5, right?
1 by 9 karo. I mean that's what it says.
No, 1
1
by
by
5.
9.
It is
1 by 9 कैसे है? Only 5 years है ना यहाँ पे.
It says 1 second. Reading
1 by
it.
5.
1 by 5.
1 by 5. Or else I can write it as 0.2.
Later one. Yeah.
0.2 over
Close.
Bracket closing minus
Minus
1.
minus 1. Right. Perfect. इसको अगर हम लोग 2 ये दे देंगे, 2 decimals दे देंगे, it will be exactly. Is this the correct one?
Yes.
Right. Okay. दूसरा के लिए,
It will be the
see,
same.
for the next, we have to add both the things. Same formula I'll adopt to the power है ना, pivot WER, then bracket close. It will be again bracket close. This plus
No, ending value
this
divided by. Okay.
divided by this. I need to add both, right? Oh, sorry.
No, it will be B11.
नहीं C10 नहीं है, B11 plus
No, ending
D11.
value. Ending
D11.
value will be C10 plus D11.
B11. Okay. उसके बाद divided by 95 plus it will become 2495. Right?
D10 it should be, right?
Huh?
Sorry, it should be C10, right?
C10.
Instead of B11, it should be C10, right?
Yes. C11.
C10.
C10. Right. Okay, these two are covered. ये तो हो गया एक तो
comma point 2
now comma
point
point 2
minus 1 bracket close bracket minus 1.
is the bracket minus 1. Okay, is it this?
Yeah,
I'll
20%.
convert into percentage.
Yeah.
You can just press Control Shift 5.
Is that correct?
Yeah.
Yes, yes,
So I think it is tallying with what he has given.
yes.
So this is how we have to calculate. So what is the IRR he has generated for this investment, right? So
this is not IRR. This is not IRR. This is CAGR. Right?
no, he wrote it as IRR. IRR or CAGR is more or less the same. Internal rate of return we call it, and that is a compounded annual growth. Both are the same. And then the VC valuation, venture capital valuation is what he was talking about. How much, how many equity shares is to be given to the, equity share holder. वो एक बार करके दिखा देता. See, if you go through the problem statement says Vijay is a partner in a venture capital firm. He is planning to invest 5 million in a tech startup firm. The company has forecasted a net income of 20 million in 7 years. A few profitable tech firms are trading at 5 PE multiples, PE ratio of 15x, and the company currently has 5,000 outstanding shares. Vijay believes hurdle a rate of 50% for a venture of this risk. Calculate pre-money and post-money valuation. Okay, you tell me.
Putting away 5-star chocolate into the dustbin that was full.
Katu, why did you
Because
do
of the putting through a 5-star chocolate. No, Mama sleeping.
that? Okay, go to Anicha.
He's sleeping.
Okay, I'll come you later.
No.
Now is not possible. I'm busy with something
Threw the
else.
5-star chocolate into dustbin.
Okay, now this is basically VC
She threw chocolate into dustbin.
VC valuation. So what is given is, first is investment, which is 5 million. I'm just putting it as 5. So next comes is the number of years or the horizon. Time period is 7 years.
I think it is in 2 decimal. Or it is in a percentage. Yeah, you should go to number. Suresh, there is a shortcut for all the formula for the number. If you just go to the number in the above GUI, so it will be easy that it will be in a one click you can complete.
What?
Just go to the comma, you will get the decimal.
Comma.
Ah, yes, that will come as a normal number. Yes. Click it. Click it. Niche also. Then you again retype it. Fine.
Yeah.
No.
Sean Cheta is laughing. Sean Cheta was laughing.
It isn't. नंबर का नीचे आरो क्लिक करो.
Wait. वो सारा adjustments करना पड़ेगा.
Yeah, you should. It is in the percentage format. You need to make it as a normal format.
Yeah.
Number format.
Kuti broke something. She broke everything now.
You enter again.
Acha, it is not reading yet. I have to write like this one. Okay. Time period is how many years? 7 years. Right?
No, that is wrong actually.
That we can do it somewhere later, you know. But now we see hurdle is cut to. We see hurdle. This is 50%. Okay. So VC hurdle IRR is 50%, whereas P multiples is 15. Existing outstanding shares, you know, existing net income. How much? Income forecasted is somewhere around 20 million, right?
20 million.
Okay. And existing outstanding shares. OS shares.
Currently has 5 lakh share outstanding.
5 lakh. Right? Is that okay?
Yes.
So what is the, you know, pre-money valuation and post-money valuation? Now we have to calculate
Carbon dioxide.
what would be the investment you would be making.
Look.
So the terminal value is basically it is calculated as, you know,
Exit
the
value.
terminal value. That will be terminal value divided by 1 plus hurdle. Hurdle is 50%. So 1.5 to the power of 7. We have to calculate the terminal value. Let us try to calculate this terminal value here. That is at the end of the period. After 7 years. 7 years will be 15 into 20. This is what is the terminal value expected. 15 into 20. That is 300 million. Right? So this is the 300 million is the terminal value of it. So out of which, what is the actual, you know, investment he has to make if he has to get IRR of 50% over a period of 7 years? That will be,
Suresh, sorry to
Yeah.
interrupt. I will just tell you that I think H column, when you put 30 into 20 into 15, you got it, or you will be putting in the formula?
Yeah, I'll put it into formula, not an issue.
No,
So
what is that you put
this-
just F2 करो H3 में H2 में.
No, इसमें terminal value is basically the amount.
No, I know that. Just go to that H2.
H2.
Make it automatic, right? Rather than writing.
हाँ मैं क्या बोल रहा हूँ, बिकॉज प्रॉब्लम इज दैट यू पुट इट हियर इज एन ए नॉर्मल नंबर, उसमें दो दो
Okay,
जीरो
okay.
ऐड करके कर दिया, सो इट विल हैव ए प्रॉब्लम. एक काम करो, 1 मिनट रहने दो, ऐसा रहने दो. आई विल टेल यू, जस्ट होल्ड होल्ड.
हो गया, हो
नहीं
गया.
नहीं 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 नहीं, to create another problem which you are not seeing. Just second, I'll tell you. Just escape करो. Hello, I'm audible ना? I think he's stuck.
Yep.
Yes, yes, you are audible. I think,
Vikram,
Yes,
yes,
He's
Suman.
not able to hear you.
Praveen, yeah, you audible.
हाँ सुरेश जी,
Yeah.
see, just go to again H2.
Again to H2.
H2. What is that you put? No, you should not. Okay, anyway, just come to some number, put it in the H3. I want to just change that format thing. Just come to H3, put 100, just 100.
Dad, you keep cutting
Enter.
for 8
Wait,
million
no.
years. Dad, you
No, it is coming as a 1.
Kerala for 8 million.
One, because it is taking as, 2 decimals.
Dad, you
No, even it's not decimal. Entire sheet is in the percentage format.
That's why आप आगे का एग्जांपल भी वही हुआ था. वो जो भी नंबर टाइप करते हैं ना, वो 2 डिजिट उड़ जाता है, अपने आप उड़ जाता है.
नहीं नहीं, अभी आपने उन्होंने 50 into 20 किया ना, then it would have been it is showing a correct number. So that's the reason this entire calculation will get into error in the future when you calculate the pre-money, post-money. That's the reason we need to first correct the
Hey,
format.
let us check it. If there is any problem, then we can make a change.
Done. Okay.
Bolo. So now the discounted terminal value will be like he has invested into 7 years with a hurdle rate of that's so-called 50%. So we will divide this number. उसको क्या बोलते हैं उसको?
Present value only.
This divided by 1.5 to the power of 7, right? It is exactly 17.55 million, right? This is the value he will be deriving after 7 years of investment for an investment value of 5 million, right? Based on his hurdle rate of 50%, right? Because this is what he is expecting. Without this much of IRR, he cannot invest into it. So this is the terminal value. Now for this, how much he has to invest, right, to get ownership? Now we have 5 lakh existing outstanding shares, right? So this is wait a minute. I'll just put it in this way. This will be like required percentage ownership. That will be investment divided by DTV. What is the investment? Investment is your 5 million divided by DTV is this. So this is, if you convert into percentages, it will be 28 point 28.48 or somewhere around 28.5%. Okay, if I put it as 1 decimal, it will be 28.5%. So he has to invest 28.5%. So a number of new shares to be issued. This is equal to the number of shares existing into 28.5 percentage divided by 1 minus 28.5 percentage. So that will be around 199301. Otherwise, you can it'll go up to say 2 lakh. Let us, for our convenience, let us put it as 2 lakh shares, right? So what is the price of the new outstanding shares? That will be 5 lakh plus 2 lakh. That's 7 lakh. So post valuation, it's post rather you can say post investment, the outstanding shares will be 7 lakhs. So now we have to calculate what is the per share price, how much he got it for. So new per share price equals to, he invested 5 million, right? That equals to 5. So divided by 2 lakh. So it is 25. This is the value per share. So implied post money valuation will be that is 7 0.7 million is equal to 0.7 million point 0.7 million into 25. This is the answer. Like you understood, this implied post value valuation will be equivalent to what we have calculated in the past. Based on we are deriving it from the share value, price per share value into multiplied by number of new shares. like 7 lakh shares into 25 will give 17.5, which is the same as what we have arrived in the DTV method, like discounted terminal value, which we have identified. So both are matching.
So just click on the formula of DTV value.
DTV value का formula यही है, 300, that is terminal value, divided by 1.5 is hurdle rate is 150%.
Yeah.
So that will become 1.5 to the power of 7, because it is invested over a period of 7 years. So to the power of 7 करेंगे तो 17.555 something आएगा, but which is equal into, we can put it as 17.5 effectively. So ultimately, based on that, we have identified what will be the required ownership for this. That we have we made it like if what is B3? B3 is this investment divided by this terminal value, right? 17.55 जो कुछ है. If you divide it by that, you get 28.5%. So based on that, we are going for to find out how many number of new shares to be issued. So if you apply that formula, like the formula is B8 is existing outstanding shares is 5 lakh into 28.5% divided by 1 minus 28.5%. It is giving you 2 lakh shares. So new shares to be issued to this investor is 2 lakh. If you add 2 lakh plus outstanding existing shares of 5 lakh, the total new shares will be 7 lakh. So now later what we did is, yeah.
Surajji,
Yes.
if I may allow, so if you look at the exit P multiple, which is again 15, right?
Right.
So I'm trying to reach that number of share to be issued the 2 lakh, right? So how you got this 2 lakh? Means what are we going to achieve the terminal value of 300?
Yeah. What we are doing is, we are trying to find out what is the terminal value at the end of 7 years. We will arrive
Right.
it based on the present multiple, that is existing net income, which is 20 million into multiples is 15. So it is 300 million is the terminal value. But since there is a hurdle factor, hurdle IRR, which he is expecting it to be 50%, because this value you get it only after 5 years. Sorry, 7 years.
Okay.
So you have to identify what is the value on that particular date, like terminal value based on a discounted cash flow method. So what you do is 300 divided by, you have had a multiples of 1.5 to the power of 7. So that will be 17.5. In fact, we got it at 17.5583, but
it is nothing but it is nothing but a present value of 300 crores at a discounting rate of 50%.
Absolutely.
That's okay. But how you got the required percentage of ownership?
See, required percentage of ownership is, for this terminal value, what he is doing is, he is taking up the investment is somewhere around 5 million, right? For 5 million,
Yeah.
for 5 million investment over the total terminal value, because he also invested. So that will be 5 divided by 17.5, right? Will be
See, Vikram,
28.5%.
End of 7 years, the firm value is 300. If you consider that based on the PE multiples and the net income, so your value after 7 years is 300. But if you want to know what is the present value, it is 17.5. So if it is 17.5 is a current value, then already there is an investment of 5 which is coming in. So overall, what is the amount of percentage which you need to give a share? It is almost 28.5% of the share dilution you need to give because of the PE or venture capital which is coming.
Got it. Now got it. Yeah. Thank you.
You got it? So should we do the next one also? Agar dilution, if it goes up to 30%, or this is okay?
So similar again.
Similar. अभी क्या करेंगे?
Let's do that next, so it becomes familiar to everyone then.
Yeah.
Very good.
इसमें तो I'll just take a little break and I'll just come back. 2 minutes. So in this particular sum, like there is a further dilution expected, right? So in further dilution expected, he has 20. He want to have 28.5% as his equity. This equity is confirmed, right? The dilution. Now here I am writing it. Okay. So now it will be like required current ownership. This is to compensate for the dilution. So how much we are expecting? Somewhere around 30% of dilution. So this 28.58%, you will be taking this.
So 30%. To take now, we are assuming that 30%. We should assume as a 30% straight away dilution.
30%. No, now we have to calculate how much he has to take, right? So it will be 0.7. 1 minus 30% is 70%.
Yes.
So 100 minus, so it will be 0.7. If we put it as 0.7, it will be like he has to have minimum equity of, if we convert it to percentage, it will be 40.68. This is the extent of dilution, like to compensate or rather to have the same amount of ownership, 28.5%, he has to take the ownership of 40.68%. So how much he has to invest is like total number of shares will be total number of new shares. In this I am doing it, or should I put it here? Okay, I'll put it. Total number of this will be simply 5 lakh. 5 lakhs is the existing shares. So I'll put it as into 40.7 divided by 1 minus 40.7
She said not to pay the back. Not to pay the. Okay.
it will be roughly 3,43,170, but in the problem it is shown as 3,43,373. Anyway, it's only a minor change in the decimals.
No, the reason is that you mentioned 40.68 ka jagah mein 48.7%.
Should I make it as 6.8?
Yes, you even put a link of H5.
Yeah, if you use the link, it will come out right.
Wait, let me check. See.
Both the places you need to do that.
No, face. Still there is a difference.
Yeah, it will be decimal, na? Because you are able to see only 2 decimals.
Right. Okay. No, still that 7 is even a better figure compared to this. Okay, whatever it is, this is what the number of future shares he has to pay. Like this is the shares he has to get allotted. So what is the price per share? Price per share will be, in any case, it will be, that is equal to 5 million already, right? Divided by so the share price is 14.56. So implied pre-money will be, here I am writing implied pre-money valuation, that is prior to issue of equity shares. That will be, since the share value is 14.57, that is equal to 14.57 into number of outstanding shares are 5 lakhs, right? So this will be the answer, 7.28 million, and then implied post money valuation will be this will be, you have to add 5 lakh plus this one, it will become a 0.84, right? 0.84 million.
Right.
So
5 plus 3, 8. H7 plus H7.
चार्ज पोर्ट करना है
Whole bracket करना है. Into H8.
that is 12.28.
Done.
Right? I think this is okay.
Yeah, I think so. It's similar to
I'm still stuck on the 40.
40.
The 40.68. Yeah.
Where?
The 40.68. Ownership.
Ownership, na? Acha, I'll tell you. Okay. See, he has to own 28.5%. If there is no dilution, to maintain the same level of ownership. but they are expecting a dilution of 30%. So what you will do is simply you can do one thing. 48 point ये जो 28.5 into 1.3 कर लो. Let us do it this way.
So basically, what they are talking about is if they go for an IPO and dilute 30% of the total shareholding in the IPO, then what should this VC be asking for as a ownership upfront?
Yes, yes.
Rather than
Absolutely.
going at 20. Okay.
Absolutely. No.
वो वैसे
It's
नहीं
also
आता है
not
सुबह
correct.
वो किया था
नहीं
मैंने
आता है,
मेरा भी
नहीं आता
37 आ रहा था
नहीं आता है.
That
इसमें
is
मैं
equal
देखा
to 30%, na? You have to put equal to 30%, and then what is the 70%?
इसमें क्या है? If you go through this, what we are doing is this H4. H4 is what? H4 is
28.5.
28.5% divided by, since there is a dilution, existing shares will become, including his, become only 70% of the future, right? So you divide it by 0.7, you will be getting 40.68. So in order to maintain the same level of ownership, which is 28.5%, he should have acquired post dilution around 40.68%. So this 40.68% will translate to around this 3,43,170 over the existing shares.
No, the below part is clear. I was little bit concerned on the 40.68. Yeah.
40.68 is clear now, or
yeah, it's clear. It's clear. No, it's clear.
Again, you just see the formula. 5 lakh is outstanding shares into 40.7, which will be your asking rate, new asking rate, divided by 1 minus, because there will be again a further dilution. So 1 minus 40.7, that will give you 3.43. This is the number of shares he has to own to have the ownership of 40.68%. And then once you got this, you got 3.43 lakh shares, which is to be issued in favor of Vijay. So now what he will do is, what we have to find out what is the per share price of this entire value. Per share will be calculated based on, what is the entire value is around 5 lakh is the investment, right? 5 lakh is what he has invested. So at the end, he got 33,43,170 shares. So if you divide it by that, it will be around 14.57. So $14.57 is the per share value of this particular, or the price at which he procured is 14.57. So abhi pre-money valuation will be, you have to divide this for per share value into the existing outstanding shares, which is 7. That is 5 lakh shares. And then now during post valuation, money valuation, the existing shares got increased by 3.43. You add 3.43 plus already existing 5 lakh, which will be 8.43. So you divide this valuation, you multiply 14.57 into this 8.43, you will get 12.28 million as the post money valuation.
Yep, now it's clear.
Now it is clear. Only this is the one I think maybe asked in this entire session. Is that fine? Should we call it a day?
Yes, sir. Thank you.
Thank you all. Thank you.
इसी में ही सबसे ज्यादा टाइम हुआ है.
Thanks.